because what you don't want to do is fall in love with a house that you can't get.
Oh, it's the worst feeling.
It's the worst, and I've seen that happen.
Yep.
It's not that it's a waste of time to go take you to look at houses. We love to show houses to people.
Right.
It is literally when you see a house, fall in love, and then you can't get it. What do? You compare every house to the house that got away. Right?
I had an experience, like my own personal experience, being a first-time home buyer way back when I was 21. And this certain price range, I was $5,000 off from the house I wanted. I just couldn't qualify. And every house after that, I did. I was like, but it's not like that one. But it's not like that one.
Our goal is to try to avoid that
Yeah.
moment. All right, guys, welcome to the next episode of The Den, brought to you by the Knox Real Estate Group. This podcast is geared towards all things housing and our growing community here in the greater Knoxville area. Today, I am joined by Kim Moye. Kim is with Mortgage Investors Group. She is a mortgage loan originator and has been in business for 28 plus years, bringing a lot of knowledge today. So Kim, like 28 years, that's a long time in the mortgage
Such a
business.
long time. 20 years is a long time. Oh my gosh. And I'm always still learning.
So tell me a little bit about the last 28 years. Tell me a little bit of the history, because at the end of the day, if somebody's watching this, like, why should they, why do they care what you have to say? Kind of, but you have 28 years in the business,
Yeah.
so there's a lot of experiences there, I would say. So,
Yeah.
Currently, you're at Mortgage Investors Group.
Right?
How long have you been there?
I've been at Mortgage Investors Group 7.5 years.
Okay, which that in itself is a long time,
It's a long
because
time.
sometimes loan officers have a tendency to jump around a little bit.
Yeah.
So you've been there a long time. That's
I have.
what did you do before Mortgage Investors Group?
So I was with a broker, so another mortgage company, but they're a broker, I was with them. But I started in this business. Let's back up. When I was 19,
Okay.
right? 19 years old, talking to buyers about a 30-year mortgage when I was just paying rent. I mean, I'm just starting out on my own. That is insane to me.
And were you with a broker then?
I was.
Okay.
So the first couple decades of my business was broker. I was a broker.
Okay. So for those that don't know, what is a broker?
So a broker is a mortgage company that has different lenders available to them, so that way they're shopping around for those buyers and their programs and their interest rates.
Okay. So, but ultimately, they're just like the middleman of that deal.
Yeah. So you're not closing in your business name as a broker. You're closing in that lender that you've lined up the client with, the buyer with.
Gotcha.
So there's delays there.
Well. So, and some people may not know this or not, but I also at one point had my license. I've done a few loans in my past.
Mm-hmm.
Not anything near like what you have done. But I was also with a broker. And I will tell you what was frustrating about that was because every lender's different.
Mm-hmm.
So one person has to somehow know that lender's ins and outs and what they take and what they don't take. And,
Yeah.
So versus where you're at now,
Yeah.
with Mortgage Investors Group, or commonly known as MIG, you will hear MIG brought up a lot because that's what they go by. But at Mortgage Investors Group, it's different because how?
Well, they're different because we close in our name. We are the lender. It's our money. Our underwriters are right there. We're not calling the representative for the broker to get a hold of the underwriter to ask those questions. So there's none of that middle. We are our underwriter. So that has a lot of value to it and helps with the speediness of getting closings quickly.
Yeah, which you guys do, and so that being able to get right to the underwriter, that's where, like, I think where the problem solving really comes in, because if you haven't been through the mortgage process, there are the underwriter, the lender, the loan originator, let's say, your job is to basically prepare a package to submit to the underwriter.
Right.
And the underwriter is basically kind of the gatekeeper for that loan.
Sure.
Right?
Yeah.
And so, like, when you submit that package, they're always going to more or less kick something kind of back and say, hey, like, I need this, this, and this, or I need somebody to explain X, Y, and Z.
More questions.
More questions.
Yes.
So, but once you are very familiar with how that process works with those underwriters, then that makes it so much smoother, I would assume.
Yeah.
So, okay, so 28 years, that's a lot of homes, it's a lot of loans. You've got
a lot of ups and downs.
A lot of ups and downs, yeah. Yes.
A lot of market changes.
So that would have been pre-2008?
Yeah, it was. Yeah, it started in 96, 97, I think. So yeah.
So you were in there when the market was going up, and then the market just Titanic.
Yeah.
Just,
foreclosures.
And with that, because I was selling real estate during that time, a lot of changes in the industry.
Yes. After that, there was a lot of guidelines being tightened. So, there used to be where you didn't have to verify someone's income. Well, now, or shortly thereafter, and then since then, because there was a lot of regulations that changed after that. We learned a lot from that. So now it's 2 years tax returns, 2 years W-2s. We verify income. Now, we're quite a ways away from that 07, 08, so they're starting to see some programs come in that are, stated income. So, but the loan to value, for which there needs to be some equity, there needs to be bigger equity than what there used to be.
Gotcha.
We're still learning.
There's still a lot of safeguards.
There are still a lot of safeguards.
And I will say, so we saw, because the market didn't know how to react, but when COVID happened and everything kind of shut down, there was kind of an instant tightening in mortgages too. Like we saw credit score minimums bump up, and I think a lot of the lenders, so the lender being the actual company that gives the money, the lender tightened up, so they didn't want to create a scenario kind of like 2008 again.
Yeah, they didn't know what direction
Yeah.
things were going to go. I mean, who knew that our market, Tennessee, would be flooded with out-of-state people? Who knew?
So let me ask you this question. You had already been in the business a long time before. Why did you choose to go to Mortgage Investors Group?
So Mortgage Investors Group has always been a thing in the back of my head. In my broker career, I've always come up against on the streets and talking with clients and realtor partners, Mortgage Investors Group. And I actually interviewed with Chuck Tonkin, one of the owners, way back in the day.
Okay.
And it wasn't a good fit then, but it was always in the back of my head. Mortgage Investors Group is a local lender with a huge footprint in Tennessee, maybe East Tennessee, but in Tennessee, and we're expanding in other states. But they're well known. The owners of the company they are customer first. They want to make sure the customer's taken care of. They want to make sure closings are done on time, and that's valuable, and that's why they have such a great name.
So it's a locally owned company.
Yes.
So
right here in Knoxville, Tennessee.
Right here in Knoxville, Tennessee.
Yep.
Kind of crazy.
Yep.
Because it's not a small company.
No.
Yeah. Is it the number one lender? Number two?
I didn't get my stats beforehand.
Okay. Well, I know they're up there, and I know there are some programs that they are like a THDA.
We're consistently the number one THDA lender.
So there's definitely some benefits to having that backing by a big company.
Yeah.
Well, awesome. So one thing I didn't say before we kind of kicked off is you are one of our preferred lenders, which is a very short list. Okay. And part of the reason why you're on that short list has to do with that experience. Has to do with the company. It's the combination of the two. Some other things, that put you on that list. Communication. Your office, like we're sitting right now in Farragut. Your office also sits in Farragut.
Right.
So there is, in a world where we live by emails and text messages, the ability for us to communicate and even get face to face if we need to. People don't realize how that can make such a big difference because problems happen in mortgages.
Oh yeah, and they don't happen just from 9 to 5.
They don't just happen 9 to 5. Like you've got to be able to like talk and brainstorm and figure stuff out.
Yeah.
So that the person who's wanting to buy that home can do it. So anyways, that I just wanted to say that because some of the things we're going to talk about kind of going forward are all things that we've learned over the years. Okay.
Yeah.
So let's start off with kind of a list of like where do people go wrong when they're wanting to buy a house? Like what are the things that they just don't get right? And one of the first things I wrote down, and people may not even think about this, but lender first versus agent first. What's your thoughts on who should the buyer contact first from your standpoint?
Oh, well, from my standpoint, they should contact the lender.
Okay.
Because they need to figure out, one, can they even qualify right now? I mean, what's the point of getting excited and looking at houses if you can't buy? And so to know that, you need to talk with the lender first. You need to talk with me first.
Okay.
Yeah.
So I'm gonna say, from my standpoint, and I'm gonna say the agent first. And what I see a lot of agents do is, they'll get a phone call from somebody. That person will say, "Hey, I'd like to go see a house." Like, because what gets consumer excited is going to go see houses.
Sure.
It's shopping for a home. Finding an agent's not exciting. Finding a lender's not necessarily exciting. A title company's not exciting. Finding a home's exciting. So they call up the agent. They say, "Hey, I'd like to go see this house. I saw your sign in the yard." And like one of the first questions that agent's going to ask is like, "Are you pre-approved? Are you paying with cash?" And like, what, 80 something plus % of people get a mortgage, right? So they say, "Well, no." And then that agent's like, "Well, you need to be pre-approved before I can show you the house." And then they just send them off into the ether to go find a lender. And to me, that's completely wrong. Okay. What I feel should happen is that's from the get-go is an opportunity to understand what that person's situation is, right? Because there are a lot of lenders. There are lenders that do different things, okay? And not everybody's situation fits into a box, into that peg.
Right.
So if as an agent, if we're doing our job right, we're going to talk to this person and figure out who the best person is to refer them to. Okay. Number one, that saves the consumer time.
Right. True.
It also can save them a lot of heartache by them randomly finding a not so good lender.
Yeah.
And so that's why I can totally understand from your standpoint, like, yeah, I want you to contact me because I'll get you all hooked up. But from my standpoint, we're kind of like I don't know if you want to call it the coach or the quarterback or whatever, but we're the person who throughout the whole thing is helping to direct this person, right? Like, hey, here are some good home inspectors. Here's a good title company. Oh, we had a problem with this. This is, so we figure all that out. Well, if you come to me with a lender that I've never heard of, you come to me with a lender from, somebody in Nevada. How do I know that lender actually really pre-approved you?
Sure.
How much did they dig into your stuff? How are we going to communicate? Oh man. Okay, so I'll
story time.
Yeah, I'm going to tell you a story of one of the buyers Sean on our team was actually working with, and he came to. He was actually a referral from another agent. Came to us from Alaska. Okay, and he was pre-approved with a friend of his who was in Hawaii. Okay. I do not recommend this. I do not recommend this at all. He went under contract on a house. Like 3 days before closing, found out he was not getting the house. Um, two things. One, he didn't get the house. Two, they're not friends anymore.
Well,
Yeah. So one of the big problems with that one was their market is so different
mhm,
that like they were asking for things
mm,
that nobody here asked for.
sure.
I mean, we literally couldn't provide it. The other thing is the time difference
Yes.
was so drastic.
Yes.
I mean, we're at the office by 8 o'clock in the morning. You know, you're like, hey, I need to know this.
Yeah.
Well, they're sleeping.
Yeah. Let's get the ball rolling, and
Yeah,
you got to wait till 12 o'clock
yeah, like
to get a hold of them.
it's crazy, and
Yeah.
and hopefully they respond to you by 12.
Right.
Right? It could be 3 o'clock in the afternoon,
Oof.
and then like it was so frustrating.
Mhm.
And it was frustrating for obviously that buyer, um, frustrating for Sean on our team because, you know, when you get to 3 days before closing, there's a lot of work that's gone into it.
Yeah.
So, anyways, and not to mention frustrating for the seller because the seller had their house on the market for about 2 months um, for it not to go through. So, nonetheless, he's got a few things to work through, and we'll be back, and we'll work with a local lender.
Right.
So, okay, so I say agent first, you say lender first. So let's talk. I kind of hit on this, but out of town versus local lender.
Oof. Yeah. Oh, local. But I'm local.
Yeah, well, you're
But local is good.
it.
Same time zone, like you just told the story.
Yeah,
I mean, I know our market because I live here and I work here and I play here and I worship here. I mean, I'm here.
yeah. I 100% agree. People don't realize that there are differences, even in Tennessee, between East Tennessee, Middle Tennessee, and West Tennessee.
Yeah.
Like the process is different. Um, I have found that I have found that when we have a buyer working with an out of town lender, there are certain things that don't happen in the same order
Or the same words.
or the
They-
same. Yeah.
they call things differently.
Yes. One of our pet peeves is when the lender just orders the appraisal.
Mm-hmm.
Because one of the first steps when you go into contract, one of the first steps is the inspection.
Sure.
And if you're not going to get through the inspection, why would you pay for an appraisal? So we try to, now there's time limits, but we try to manage that.
Well, and there's also some negotiating that goes down. And tell me if I'm right. And this is my thought process. If a lender orders the appraisal right off the bat, does the real estate agent lose some power in negotiating?
I will say that as an agent, if I know that the other party has already ordered the appraisal and it's already scheduled and things are moving along, then number one, I feel as if there is definitely a sense of urgency on the buyer side, right? I now know that they have roughly $1,000 to $1,500 possibly
Between the inspections and the appraisal order. Mhm.
Yep. So I would say that the deal feels more solid. So if they come back and ask for, a bunch of minor stuff, then as a seller's agent, we're probably going to be a little harsher for sure.
Okay, yeah.
Yeah. The other thing is let's just say that appraisal's got a quick turnaround, and we're already told that it appraised
Mm-hmm.
with no conditions, right?
Sure.
Well, now if you're the seller, you're like, well, the appraiser didn't have any issues. So yeah, the biggest problem with it is, I mean, there is a timeline in the contract, okay? So we have to abide by the contract. There is a
Sure.
timeline, but the goal is to get the inspections done and cleared up as soon as possible because nobody wants to sit off the market. But ordering that appraisal in advance is just a shot in the dark.
Right.
And it's something that a loan officer who's just like, I'm just checking stuff off my list.
Right.
That's what they do.
Yeah, so that's local. We're talking local versus not.
Right.
Local lender, we're going to be in communication. When's the home inspections? Oh, okay, cool. We'll talk right after that. We're still in that time frame that we need to order it. But a not local lender may just be check mark by day 2 and just get it done. Just get it done. Just get it done. And that's not necessarily the right game plan.
Well, and that's the benefit of also working with the lender that your agent refers you to, right? I mean, I wish everybody would call me to do real estate and everybody work with my lenders. But what you should do is talk, if you have a trusted real estate professional that you know will help you buy the house, you should be asking them who they recommend.
Yeah.
Because you want great communication between the lender and your agent,
Yes.
right? You want somebody, there's also a thing, there's power behind referral-based business,
Yes.
okay? When you find somebody online, you are just another application, right? And if that deal doesn't go, or if that lender doesn't communicate with your agent, if the deal is horrible and you still close, doesn't matter. They got the business, they move on. If they don't close, doesn't matter, they move on. They're just working more online leads, right? You're just a number.
Yeah.
But when you're referral based, we're all working hard so that we all continue to earn those referrals,
Yeah.
right? And we want the experience to be the best it can be for the consumer. And so always, always, always ask your agent who they recommend.
Well, yeah, and I'm invested because that's another person moving into my community. I mean,
Well,
that's super cool.
Well, on the flip side too, we all talk about shop local, support your
Yeah.
local business. So like when you do your mortgage with an out of state lender, that money that they earn off of that deal ends up going out of state,
Yeah.
right? So it doesn't benefit the local shops, businesses, schools.
You invest in
Ch-
the schools on
ch-
all your closings, don't you?
Yeah, we do quite a bit, yes.
Yes, you do quite a bit.
And so in charities, like you're investing in your local economy, especially if you're moving into it. Like, why wouldn't you?
Yeah.
So there definitely, I'm definitely pro local lender. Now, with that being said, if somebody is set on, hey, I'm going to use XYZ company, then we work with it.
Yeah.
And we hope for the best. Like,
Yeah.
fingers crossed, we
Yeah.
hope for the best. So one last thing on that, where I've also found that there is sometimes a rub, is when it comes to title companies, because the title company's local, the agent's local. When the lender's not, they, shoot off their communication to the title company, and then without a doubt, I'm normally getting an email saying like, well, it's been 24 hours, I haven't heard from the title company. Well, no, like, I don't know how you do it over there, but I never get these emails from local lenders. I never get the, like, I'm still waiting on this. Like, our title companies that we work with are some of the best in the business. And like I said, hundreds of deals closed, no issues, but always with an out-of-town lender, there's always something that pops up there. And I'm just like, what are you doing? Are you pushing the wrong button? I don't, it's weird. Okay, so moving on. So far, I don't know who won the lender first, agent first.
I feel like it's a 1-1.
Yeah, that might be a tie.
Might be a tie.
I think local lender obviously won on that one.
Yeah.
So this one's not really a versus, but I want to talk about credit scores because we're talking about where people go wrong.
Yes.
So where do you see people go wrong with credit scores?
With credit scores. Well, there's a few different avenues, right? But one, they don't know where they're at. And that could be hurtful. They don't even know, they have no idea. So you want to have an idea of what it would look like. And then two, there's this wonderful green phone app that people monitor their credit scores on. And I mean, it's a good tool in that, okay, oh my gosh, I owe more on my credit card now, and it looks like my score went down because my credit utilization went away or is not as much. So it's good to see. That's cool. I mean, I have it on my iPhone as well. It's cool to see, oh yeah. But it's not the same as when a lender pulls your credit. That score can look different.
Okay.
And it can look vastly different.
And so I have heard, I'm sure you've heard this too. People want to get pre-approved, but they're like, I don't want you to pull my credit yet.
Right.
And that's where I think they kind of go wrong. Like, It's like, what's the point?
Right.
At that, like, I'm just giving you scenarios, but that credit score is very important to the whole process.
Yeah.
Correct me.
I'm not giving you a pre-approval letter because I haven't pulled credit. There's no way. I mean,
Right.
there's so many different things that come up that when you view the credit report, and I'm not going to have you show a property to a borrower, or a borrower go look at a property falsely thinking they can buy, write an offer, and then they're going to let me pull their credit, and I pull it, and then surprise.
Right. So the things that can come up when you pull credit. One, the score could be vastly different.
Can be.
Which, what I mean, that affects two things, right? It affects one, do you qualify?
Yeah.
Because there's a hard line.
Right.
In every deal, there's a hard line.
Yep.
If you're below that score, you don't qualify.
Right.
And then it helps determine what interest rate you get.
Yes, and then interest rates determine payment, determine qualification, determine price range. So it's huge. Credit scores are a huge deal.
So that's probably, I mean, definitely one of those things where, you talk to somebody and you're like, okay, so, and some people think they know, like you said, they use some of these services, they think they know what their credit score is. But until you've had that conversation, you've had your credit score pulled. The other thing is there's things that could be on your credit that you don't know that come up in that credit pool that need to be addressed.
Yeah.
And it's not the end of the world. It happens to a lot of people.
Yep.
I didn't know that was there. Man, that was from so long ago. Whatever. And like, then that gives you the opportunity to have that game plan long before they ever. So kind of going back to before, I do agree you should get pre-approved before you go see houses.
Yeah.
Right? Because what you don't want to do is fall in love with a house that you can't get.
Oh, it's the worst feeling.
It's the worst. And I've seen that happen.
Yeah.
Right? It's not that it's a waste of time to go take you to look at houses. We'd love to show houses to people.
Right.
It is literally when you see a house, fall in love, and then you can't get it. What do? You compare every house to the house that got away. Right?
I had an experience, like my own personal experience, being a first-time home buyer way back when I was 21, and this certain price range, I was $5,000 off from the house I wanted. I just couldn't qualify. And every house after that, I did. I was like, but that's not like that one. But it's not like that one.
It is so hard. So yeah, we our goal is to try to avoid that moment.
Yeah.
All right. So along with credit score is like debt to income, because you really can't pull debt to income. You can't figure that out until you've pulled credit, right? Because that credit report gives you all how much debt they owe and how much they pay.
Right. So that being debt to income. So we're going to look at what debt they have, which most people know what their debt is. Most people. Some people are like, well, I think my payments are this, and this, and then you pull credit, and well, maybe their credit card balance is higher than they thought, so the payment's different. So that debt's going to look different. And then, oh my gosh, let's go into even student loans. That debt qualification looks different. Well, I'm not making a payment on my student loan. Well, for lending purposes, we have to use a percentage to qualify. So that's what we have. That's another good piece of pulling that credit report, because we got to look at all that stuff.
And in what I think a lot of people don't understand or realize is that debt, so that it's called DTI, debt to income ratio, right, is also another qualifying factor. Like, this is you get the loan or don't moment. I think one mistake that I know I see a lot of people make, and it's not necessarily their fault, it's just how it happens, but especially with like younger people, is they go out and what's the first big purchase? What's the first big purchase as a young person you can make? A car.
Yeah, automobile.
And unfortunately, what I see happen to a lot of people is, especially when you're early in your career, you're not making your full potential yet, but you maybe you've got decent credit and you qualified to get this vehicle, and there's so many financing options for cars. 0% down. You qualify, but it eats up all of your ability to buy a house. And I'm not saying don't go out and buy the nice car. I'm just saying if you aspire to someday buy a home, you might want to see what that looks like.
Yeah.
Like that's a lot of planning. You may want to cut back. It may be the difference between the absolutely macked out version of the car
Yeah.
and maybe a more baseline version.
Yeah. And with cars costing so much right now and the finance options as they are, it eats up a lot more than what it used to. And that's unfortunate.
And it's hard. It's going to sound cold, but it's hard to feel bad for somebody who's like, I can't afford a house, but they got $1,000 a month truck payment. And it's not saying that person did anything. Like I said, not that they did anything wrong.
Right.
It just wasn't planned out. And that salesman at the car lot, he ain't looking out for you as far as like, do you rent or do you own a home? Right. Oh, you rent? Hey, we should probably go a little lower on the car payment so that someday you can qualify for a house. They're not having that conversation.
Yeah. So I'll tell you too, it brings up a good idea in my brain. When you do car shop, do you know what happens to those credit inquiries? Do you know what happens?
Oh, yeah.
There's a lot of them.
Yes.
And the less perfect your credit is, the more times the credit gets pulled because they're trying to get you financed. And you know what happens when you have all those inquiries on your credit report, Eric?
I'm gonna guess it's not good.
It's not good. It brings your score way down.
So it's a lot of hard inquiries.
It is, and that's not good either. So moral of the story: don't buy a car before you go, or automobile before you go look for a house.
Well, and what a lot of people, I don't think that, not that I'm in car sales, but I think a lot of people don't realize that you can get pre-approved for a car loan before you ever walk on a car lot.
Oh yeah, there are services out there. I've seen them.
When you can go to, I did it with my local bank.
Yeah.
I went and said, hey, I want to buy a car. And then I walked in and I said, hey, I'm already pre-approved.
That's one inquiry.
Right. And I've already handled that. I already know what my payment is and everything.
Yeah.
Now granted, they still wanted to run me through the thing because they also have their financial institutions that they get a little bit of, they have their little deal behind doors.
Right.
So knowing that debt to income is a real thing, if you're in a position where your debt is a little high, how are they just out of luck?
No. So again, experience, and I love doing numbers. I love number crunching. If what they qualify for now based on their current debt is not where they want to be, how can we get them there? So let's say they want the $500,000 house, but they only qualify for $300,000. Well, if you want to qualify for the $500,000 house, either one, more of a down payment, right? Well, most people don't have that. Or two, we need to look at how do we eliminate some of this debt. Car loans are not an easy debt to eliminate. So,
right.
Either you're going to have to, refinance it because you've got a lot of equity in it and bring that payment on down, take the loan term out longer to get that payment lower. A lot of people can't do that. That's not a good option. But maybe there's a lot of credit card debt, maybe some installment loans, personal loans are going to be paid out in the next 10 months. So there's some things. So that's why, again, pulling the credit report is so important because we can evaluate. I can evaluate that and advise accordingly.
And I think that's a powerful thing. That is something that I don't feel, again, you're going to get from an online lender.
Right.
They're going to say this is what you qualify for, and then you're in that box. Mm-hmm. When you're able to sit down with somebody and actually look at your options, you're going to get real advice and real direction, real possibilities of what could happen. And buying a house is not a short-term thing.
Right.
So sometimes it's okay if it takes a little bit of time to get there. Yeah. It may not be fun,
right,
but it's worth it.
Well, let's talk about that. So what about the ones that I want to buy a house and you go to pull their credit and it's below the threshold of what we can lend on, right? It's lower.
Right.
They've had some blemishes. They've had some life events that they need to work through and repair on their credit so they can qualify. Well, again, I can look at that, and we have a program at MIG. One of our credit programs is that we can go in there and manipulate, well, this is paid off. They open a new $300 credit card. This is paid down. This judgment is released. This collection's been removed. And we can see how it affects the credit score as quick as 1 month or as long as 12 months. And that's a very clear path and direction for that client to take the steps to get to where they need to be to buy the home.
So you can you can create literally like a gameplay. You
Yeah.
can say, hey, so this is what we've got.
Yep.
If we do A, B, and C, this is what we end up with.
Yep.
And if we do C, D, and E, this is what we end up with.
Yes.
Which route do you want to go?
Yeah.
And bam.
Yeah.
They have actionable steps.
Yeah.
To get the credit score where it needs to be able to buy a loan or
Right.
buy a loan. Well, yeah, kind of buy a loan, but
Right.
buy a house.
Right.
All right. So the next one I got on here is savings.
Mm-hmm.
You just mentioned down payment. Most people don't have maybe more down payment, but I think one mistake that I see people make is, and it's not so much a mistake, it's just a lack of knowing, is it's one thing to have your down payment. It's one thing to have maybe money for closing costs, but there are other expenses involved in buying a house. Yeah. And again, this is where I think stopping and talking to your agent, and then also talking to your lender, and looking at the big picture. Again, it's easy to go online and say, oh yeah, I got pre-approved, but nobody's having that conversation. You walk into an open house and you're just like, oh, hey, I want to buy this house. I got a pre-approval, boom. And then later you're like, oh, wow, I didn't know about these, right? I'll give you, just some examples. Obviously, you're going to give them a quote on down payment and closing costs, right? Mm-hmm. So they're going to most likely have that money. I mean, they're going to have it in order to buy the house.
Sure.
But it costs to move. Mm-hmm. There's the appraisal and inspection. There's, inspections are a negotiation. That means that there's most likely going to be items that you're going to want to fix when you move into the house. Mm-hmm. Okay? So there's automatic out-of-pocket expenses that within the first several months you're going to outlay. Yeah. You may want to do a little remodel work. You might want to paint. You might want to... Those are things that you need to consider when making those decisions. Maintenance. Now, every home needs maintenance.
Right.
We know a lot of the same vendors, and so we have an HVAC guy whose bread and butter is emergency heat and air calls.
That happens?
That happens.
Crazy.
Now, I always have to ask myself, why are they an emergency? And it's probably because the homeowner hasn't been paying attention to their heat and air unit. Most of these HVAC companies, including Elite that we're talking about, have a maintenance program.
Yeah.
Well, if you outlay that money, you probably won't have an emergency. So they're remodels, keeping the home current. There's a lot of things. Getting the house is important, but at the end of the day, I feel like a lot of people miss the mark on what it's really realistically going to cost to own. Now, having said that, they might say, well, it's cheaper to rent. Is it cheaper to rent?
It is not cheaper to rent.
Why is that?
Well, I mean, one, the rent costs a lot of money right now. But two, at the end of 5 years, do you have any appreciation? Do you have any value in a home that you've been paying in?
No.
Oh,
no.
So you've lost money.
And you may only get a receipt. Maybe your deposit back. Like, let's just say, I mean, if you've been in it 5 years, maybe not. I don't know.
That would literally makes me want to cry, just to think I would have paid, $1,500, $1,800, $2,000 on rent for 5 years. At the end of 5 years, I have nothing to show for it.
Yeah.
It's
yes.
terrible.
And that's to assume that the rent that you started with
stayed at $1,500.
Yeah.
Right.
I mean, so there is a lot to go with that. So I definitely feel maintaining your home is not as challenging as it sounds.
Right.
But it is something people need to really think about and understand. All right, so my next bullet point here. Sometimes I think people get fixated on certain things like the rate, things like PMI. If you don't know what PMI is, it's private mortgage insurance. Instead of like looking at the big picture. So I'm gonna pose this as kind of a question. Is there a moment where paying PMI makes sense?
So this is my take on it, on the numbers I've ran and being in business for so long. There is a point where paying private mortgage insurance makes sense because the interest rate for the loan is usually lower
Okay.
because there's less risk for the lender.
Makes sense.
That's their money, they're making the rules. So it's less risk for the lender to have private mortgage insurance on the loan, so therefore the interest rate is lower because there's less risk. Now that sounds odd because you're like, well, I'm putting 20% down. That's a lot of money, and there's not much risk there, but there is. I mean, there is.
Well, sometimes like you're able to look at like this is what it would look like if you only put X amount down, and this is what it looks like if you put Y amount down.
Yes.
And the difference in that down payment versus the difference in the monthly payment over time, a lot of people don't realize that they may not keep a 30-year mortgage for 30 years.
Who does?
I mean,
Nobody does.
Nobody does.
Right.
So the realistic conversation has to come up of, okay, so you may have this mortgage for 5 years, right? Does it make sense to outlay this extra cash to just save this little bit on your monthly payment every month? Or could you use that extra cash somewhere else?
Exactly.
Maybe pay down a higher interest, credit card or loan.
Yep.
Maybe put it in savings.
Yeah.
Maybe use it to maintain your home.
Yeah.
Like there's a lot of options there. And that's something that, I think sometimes people get fixated. They're like, I heard PMI is bad.
I know.
And therefore I don't want it.
Yeah.
Instead of looking at the bigger picture.
When I have someone that's so adamant, they're like, I'm putting 20% down because I don't want PMI. I was like, I'm going to run numbers for you both ways, and you'll be surprised. And actually, my last client, I did that for. And they were like, oh. I was like, yeah. I mean, it's not that horrible thing. And then they started having the conversation with me. Oh, well, we could use less down, and I could pay, like you just suggested, pay off this other stuff. So their monthly cash flow is better.
And so that's the thing. I think at the end of the day, you got to end up, as a consumer, you got to end up working with a lender that will take the time to answer your questions, walk you through your options, whether it be, what can I do to get my credit score better? What does even getting my credit score? Just because you qualify, so the difference between qualifying and maybe the next tier of credit score may make a big difference.
Good, yeah.
Right? So, what does my scenarios look like? A true advisor in that thing. I think you want somebody with experience. You want somebody local. You want somebody who's going to work well with your team in this transaction.
Yeah. Right?
And that team is your agent, the title company, anything that they're going to be directly involved with. So I think those are all great points. At the end of the day, if somebody has questions about, getting a mortgage, getting pre-approved, or what their options are, what's the best way for them to get a hold of you?
Oh, my cell phone's the best way because you know what? You know what you do with your cell phone?
I answer it.
And where is it at in relation to your body?
It's right here.
It's always
on me.
Mine's right there. It's always around us. So my cell phone's my best. Yeah. Best way. Can I give you that number?
Yeah, go ahead.
All right. So it's 865-806-8473.
Awesome.
I've had that number for 28 years.
28.
When I started, I got my first cell phone. That's my number, dude. I've had it a long time. Long time. Yeah.
That's pretty wild. Well, Kim, I appreciate you coming on the show today and enlightening everybody on things, little pieces of the mortgage industry.
Yeah.
And at the end of the day, I hope everybody out there did benefit from the show. Yeah. Make sure to, if you've got questions, be sure to leave them in the comments. We will respond to those. And if you need to get a hold of me, you can reach me at 865-213-2899, Knox Real Estate Group. Thank you.